What is bubble? An asset bubble occurs when the prices of assets rise rapidly within a short period, reaching levels far beyond their intrinsic value. This price surge is driven by increased demand, often unsustainable, and is followed by a sharp decline or crash in the asset's market value, known as a bubble burst. When the bubble bursts, the resulting price drop can cause broader economic challenges, including reduced investment and spending. Bubbles can form in markets like real estate, gold, and cryptocurrencies. An asset bubble can originate due to various factors, with one of the most common being a decline in interest rates. Lower interest rates encourage borrowing, stimulate consumption, increase private and foreign investment, and foster economic growth. A new product or technology can also trigger a bubble, as seen during the dot-com bubble when investors rushed to invest in anything associated with the internet, leading to inflated valuations. Investors are often driven by herd mentality, short-term goals, and fear of missing out, which leads them to pour money into overvalued assets. The first stage is displacement, where investors are attracted to an asset due to unusual events like a new technology or historically low interest rates. This is followed by the boom stage, during which prices begin to rise modestly, but media hype and FOMO push prices higher as more investors jump in. Euphoria marks the third stage, where asset prices peak, driven by irrational exuberance, and people invest without considering the asset's intrinsic value. The profit-taking stage follows, where savvy investors start selling assets to capitalize on high prices. The final stage is panic, where prices drop rapidly, and investors scramble to sell off assets to avoid future losses. In 1989, the Japanese real estate bubble reached its peak, with land prices in Tokyo reaching astronomical levels before crashing, resulting in a massive loss of value. The dot-com bubble of the late 1990s saw technology stock prices soar, with the Nasdaq index increasing five-fold before crashing in the early 2000s. The U.S. housing bubble, which followed the dot-com bubble, was fueled by lenient lending practices and low interest rates. As borrowing costs increased, homeowners could no longer afford their mortgages, leading to widespread defaults and a housing market crash.